It begins the way most disasters begin in modern history, not with noise, but with silence. A strange, suffocating silence that spreads across screens, across cities, across minds long before people understand what it means. In a dimly lit room, a trader sits frozen in front of glowing monitors. The reflections of red numbers flicker across his face like warning signals from another world. Each refresh of the screen feels heavier than the last. Each drop is no longer just data, it becomes a feeling, a pressure in the chest, a tightening in the stomach, a slow realization that something has already slipped beyond control. Are collapsing, not gradually, not politely, but in a cascading chain reaction that feels almost alive. Stocks that once represented stability begin to fall without pause. Currencies weaken against each other like tired soldiers losing formation. Entire sectors that were once considered safe begin to behave as if safety itself was an illusion. Yet, in the middle of this financial unraveling, something deeply unnatural begins to happen. Because while most assets are drowning under the weight of panic, there are a few that refuse to follow the pattern. At first, they barely move, almost unnoticed. A small deviation in a chart that most people ignore because they are too busy watching the collapse elsewhere. But then, something changes. They start to rise, not dramatically at first, but consistently, quietly, as if they are responding to a different reality altogether. This is where confusion begins to replace fear, because in theory, everything should be falling together. That is what logic suggests. That is what intuition expects. When the world loses confidence, value should contract universally. But history refuses to behave in such a linear way. It never has. Instead, collapse has always contained a hidden structure beneath its chaos, a structure that becomes visible only when everything else is breaking apart. And inside that structure, value does not vanish. It relocates, silently, precisely. Inevitably, this is the first paradox most people never truly process. When the world loses value, certain things do not just survive it, they absorb it, and that changes everything about how collapse should be understood. Because if destruction automatically created uniform loss, then crisis would be simple, predictable, flat. But it is not. Crisis is uneven, selective, almost intelligent in the way it distributes pain and opportunity at the same time, and somewhere inside that imbalance lies a disturbing truth. Every major financial collapse in history has produced winners, not despite the chaos, but because of it. Think of it as a silent redistribution that occurs beneath the visible panic. While headlines focus on falling markets, unemployment spikes, and institutional failure, another layer of movement is taking place underneath the surface. Capital is not disappearing, it is flowing, redirecting itself toward structures that can still hold weight under pressure. And those structures are rarely random. They are consistent across time, geography, and system design. Which leads to a question that feels almost uncomfortable to ask. If this pattern repeats every time, was it ever random at all? Or is collapse simply the moment when hidden rules of the system become visible? A moment when the invisible architecture of finance reveals itself for a brief window before everything stabilizes again and the illusion of normality returns. To understand this, you have to imagine something unsettling. Picture the global economy not as a stable machine, but as a massive living network held together by trust, liquidity, and expectation. Now imagine what happens when trust begins to fracture. Not all at once, but gradually, first in small pockets, then across institutions, then across entire regions, until the entire system starts to behave differently, not because the rules changed, but because the confidence behind those rules has weakened. At that moment, something strange happens to value itself. It stops being universal. It becomes conditional, and conditional value behaves very differently than stable value. It starts searching, moving, repositioning itself toward anything that can still function under stress. And this is where the real mystery begins, because there are always certain categories of assets that seem almost designed for this environment. Not in a literal sense, not in a conspiratorial sense, but in a structural sense. Because they consistently benefit from the same conditions that destroy everything around them. They are not immune to collapse. They are activated by it, and by the time the average person begins to notice them, They are already in motion, already revaluing themselves, already separating from the rest of the system, which creates a deeply uncomfortable realization. Most people do not see these movements happening in real time. They see them after the fact, when the charts are already higher, when the opportunity has already shifted, when the system has already reorganized itself without them, and so the question becomes unavoidable. What exactly are these assets? Why do they behave differently when everything else fails? And who understood this pattern before the rest of the world noticed? Because if these movements are not random, then they are not new either. They are repeats, echoes of the same hidden structure appearing every time the system enters stress. And that means this story is not just about one collapse. It is about every collapse that came before it and every one that has yet to come. To understand why these assets behave the way they do, we must step backward, not into speculation, but into history itself, where the first traces of this pattern were never hidden. They were simply ignored. History rarely announces its true lessons loudly. It hides them inside repetition, inside patterns so consistent that they only become visible when enough time has passed for emotion to fade and logic to return. Every major economic collapse carries the same surface story: panic, loss, unemployment, institutional failure, newspapers filled with urgency, families tightening budgets, governments scrambling for response. But beneath that visible layer, another story always unfolds, a quieter one, a story not of destruction alone, but of redistribution. Take the Great Depression. To the public memory, it is remembered as an era of collapse. Banks shutting their doors, savings evaporating overnight, entire economies freezing in place. But what is often forgotten is that even in that environment of extreme contraction, value did not disappear uniformly. It shifted. Those who held certain types of assets, things tied not to paper confidence, but to scarcity and physical reality, experienced a very different outcome than those exposed purely to financial abstraction. While the majority struggled with liquidity shortages and institutional collapse, value concentrated in places that could survive without trust in the system. And that distinction is critical, because the system itself was still operating different. It was just operating differently under stress. Then came the 1970s, a decade defined by instability that did not look like collapse at first glance. Inflation rose unpredictably. Currency purchasing power weakened. Confidence in traditional economic stability eroded slowly rather than suddenly. And again, something unusual happened beneath the surface. Assets that were previously considered secondary began to gain relevance, not because they became fashionable, but because they became necessary under changing conditions. This time, the shift was not driven by panic alone. It was driven by uncertainty, and uncertainty behaves differently than fear. Fear collapses systems quickly. Uncertainty stretches them. It forces capital to reassess where safety actually exists, when certainty itself becomes unreliable. Then came 2008, a crisis that felt modern, complex, and systemically engineered in hindsight. Financial instruments that were once considered sophisticated collapsed in sequence. Institutions that were assumed to be stable revealed deep structural fragility. And yet, even in that environment of global uncertainty, the same pattern reappeared. Certain assets did not behave like the rest. They did not follow sentiment. They followed structure. And while most narratives focus on what was lost during these periods, the more important question is what was transferred. Because in every one of these events, wealth did not vanish. It changed hands, slowly at first, then rapidly, then irreversibly. This is the first hidden constant across all financial history. Economic collapse is not a destruction of value. It is a reallocation of value under stress. And that reallocation always follows similar pathways across different decades, different technologies, different political systems, and different global conditions. The same types of assets consistently behave in ways that defy emotional expectation. This creates a paradox that most people struggle to accept. If every crisis is different, why does value move in the same directions every time? Is it because human psychology never changes? Or because the structure of the financial system channels behavior into predictable outcomes when stress reaches a certain threshold? Every generation believes its crisis is unique, that the rules no longer apply, that previous patterns are irrelevant. But history responds with repetition, not in events, but in outcomes. The same types of assets repeatedly emerge as resilient or even dominant during these phases of instability, not because they are magical, not because they are immune, but because they align with what the system needs under pressure. When trust weakens, value seeks anchors. When liquidity tightens, capital searches for efficiency. When fear spreads, behavior becomes predictable. And in that predictability lies opportunity, but only for those who recognize the pattern, while it is still forming, not after. This is where most historical analysis fails the average observer. It focuses on what happened, not what moved beneath it. Because beneath every crash, there is a quiet migration happening, capital leaving fragile structures, entering resilient ones, repositioning itself based on survival logic rather than optimism, and this migration always favors certain categories, not random ones, not emotional ones, structural ones, which leads to an uncomfortable realization. These patterns are not rare. They are consistent enough to be considered a feature of the system itself, not a bug, a mechanism, a response cycle that activates under stress conditions. And once you begin to see this across multiple historical events, another question emerges naturally. If the system behaves this predictably under pressure, then what exactly is driving it? Because patterns do not exist without structure, and structure implies mechanism, which means we are no longer looking at history as a sequence of isolated crises. We are looking at history as a repeating expression of the same underlying system behavior, a behavior that becomes most visible not in times of growth, but in times of collapse. And if that is true, then the next step is not to study the events themselves. It is to understand the forces that cause value to move the way it does when everything begins to break. Because inside those forces, the real architecture of financial behavior begins to reveal itself. To understand why certain assets rise when everything else falls, we have to stop looking at events and start looking at pressure. Because the financial system does not move randomly. It responds like a massive interconnected organism reacting to stress, imbalance, and fear. And underneath every crash, there are three invisible forces quietly deciding where value goes. Next, fear, liquidity, trust. They are not visible on charts, but they control everything that appears on them. Fear is the first to arrive. It does not negotiate. It does not wait for confirmation. It spreads faster than information itself, moving through headlines, conversations, and expectations until rational behavior begins to dissolve. Fear does something subtle but powerful. It compresses decision time. Long-term thinking disappears. Everything becomes immediate. And in that immediacy, markets stop behaving like systems of strategy and start behaving like systems of survival. Then comes liquidity. The bloodstream of the financial world. Liquidity is what allows assets to move, be sold, be exchanged, be valued. But when fear rises, liquidity does not disappear. It retreats. It pulls back from unstable areas and concentrates into what is perceived as safe. This creates an uneven system, where some parts remain fluid, while others become frozen. And that imbalance is where opportunity begins to form, because in frozen systems, value stops being efficient. It starts being reassessed. And finally, trust, the most fragile force of all. Trust is not just belief in a currency or a company or a market. It is the silent agreement that the system will behave consistently tomorrow. When trust holds, everything functions smoothly. When trust weakens, even stable structures begin to behave unpredictably. And when all three forces interact simultaneously, fear rising, liquidity retreating, trust weakening, the system enters a state of controlled instability, not collapse yet, but reconfiguration. This is where the first major insight appears. Value is not destroyed in this process. It migrates, like pressure pushing water through cracks. In stone, capital flows toward whatever structure can still function under stress. And this is where the hidden architecture of crisis begins to reveal itself. Because not all assets respond the same way to these forces. Some collapse immediately, some stagnate, and a small group begins to behave differently. They start aligning with the direction of pressure rather than resisting it. These are not random exceptions. They fall into consistent categories. The first category is tied to scarcity.